Welcome to Book Briefing. Today, the book we encounter is the immortal masterpiece of Daniel Kahneman, a pioneer in behavioral economics and Nobel laureate in economics, Thinking, Fast and Slow. While countless investors believe in sophisticated charts and perfect corporate analysis, what actually determines victory or defeat in the asset market is the thoughts and biases in our own minds, which are far more difficult to control than the numbers right in front of us. This book exposes the most fatal traps of thought dug by our brains. Let us begin the amazing journey to reveal the reality of irrational decision-making under the guise of reason and draw a psychological map of wealth that remains unshaken even amidst market turbulence. Kahneman explains that two assistants work in our brains. There is the lightning-fast, emotional, and instinctive System 1, and the lazy System 2 that handles complex logic like statistical analysis but tries to conserve energy as much as possible. While the two systems seem to cooperate during peaceful times, the situation changes completely when the market crashes or volatility reaches its peak. This is because the lazy assistant of reason, System 2, falls asleep exhausted, and System 1, soaked in fear and greed, hijacks the steering wheel to trigger impulsive panic selling and irrational trading. Confessing this structural limitation of our brain is the very first step of investment knowledge. According to Kahneman's great prospect theory, the magnitude of psychological pain humans feel when they lose money is a staggering 2.5 times harsher than the joy felt when gaining the same amount. This means the psychological ruin of losing 100 million won is more than twice as intense as the smile of earning 100 million won. This extreme loss aversion tendency turns investors into irrational gamblers. Even after a company's value has collapsed, in order to delay the pain of confirming the loss, investors engage in reckless averaging down or betting on even larger speculative risks. This brain malfunction starts right here. This asymmetry of loss leads to the worst tragedy in the market, known as the disposition effect. If a small profit is made, the investor fears losing that joy and cuts the flowers of blue-chip stocks too early to secure the profit. Conversely, they hate facing the pain of confirming losses on weed-like stocks, so they hold on to them forever, watering them until they break even. Consequently, as time passes, instead of compounding golden stocks, the account becomes packed with rotting, unsellable trash stocks. This irrational psychology of watering the weeds and cutting the flowers is the main culprit eating away at our portfolios. Our brains do not weigh information objectively, instead, we are slaves to the availability heuristic, relying on the information that most vividly pops into our heads recently. We distort probabilistic judgments by being swayed by the daily fear-mongering news or rumors of neighbors striking it rich. When this is coupled with the anchoring effect, which firmly ties our psychological baseline to the initial price we bought the stock, the door to destruction opens. Disregarding current market value or fundamentals entirely and practicing wishful trading based solely on the anchor of our purchase average price is like drifting at sea, bound to an anchor the brain has dropped in our minds. When an individual's minor psychological distortions expand to a macroeconomic scale, giant crowd madness erupts. As interest rates cut and overflowing monetary liquidity starts to devalue money, the public is gripped by the fear of being left behind. At this point, independent rational analysis, System 2, completely evaporates, and the information cascade phenomenon, where people blindly follow the footprints of those ahead, takes over. To avoid the existential anxiety of acting differently from the crowd, everyone rushes in one direction toward the cliff, stacking up the peaks of historical financial bubbles. The history of human finance has been a repetition of massive cycles driven by the greed and fear of System 1. From the dot-com bubble of 2000, which went wild over stories without earnings, to the Lehman Brothers crisis of 2008 that collapsed the system, and the recent concentration on big tech crossing the boundary between innovation and madness, only the appearances change, while the essence remains the same. Human System 1 is blinded by optimism bias at the peaks, showing wild greed, and gets intoxicated by extreme pessimism at the troughs, panic selling precious assets at the very bottom. You must survive on the psychological waves of this repeating cycle. The masters of the investment market never overvalued their own knowledge or willpower. First, they shattered the illusion of control, which is the arrogant instinct that they could perfectly predict and control the market. Second, they secured a margin of safety to firmly protect themselves even when their analysis or predictions went wrong. By buying at a price far lower than the intrinsic value of the enterprise, they designed a systemic airbag so that they would not go bankrupt even if psychological spasms and calculation errors occurred. Designing mechanisms for response rather than prediction is the secret of the masters. Amidst the daily flood of news, we cannot escape the trap of framing set by press and media. The optimistic frame of 90% asset preservation rate and the fear frame of 10% probability of principal loss dominate our System 1 in completely different ways, despite being the exact same fact. Wise investors must tear away the fancy adjectives or packaging of these frames. Only when they eliminate emotional noise and extract the raw nouns, statistics, and the essence of numbers to accept the transparent truth, can they finally reach a state of reason free from noise. Before actual trading, you must activate a 4-part metacognitive checklist that awakens the sleeping System 2 to cross-examine yourself. First, prospect theory. Are you selling profitable blue-chip stocks and holding onto losing trash stocks? Second, the anchoring effect. Are you obsessed with the average purchase price, ignoring objective corporate value? Third, availability bias. Are you defining future probabilities solely based on the memory of the recent bear or bull market? Fourth, the illusion of control. Do you blindly believe the market will move exactly according to the chart lines you drew? In conclusion, if even one of these 4 applies, System 1 is currently holding your steering wheel. Now, you must practice 4 steps to rise from a slave of emotion to a ruler of reason and grasp the sovereignty of knowledge. First, recognition, humbly admitting that our brains are not perfect and are full of biases. Second, control, continuing the training for the reason and statistics of System 2 to maintain leadership even in crashing markets. Third, blocking, turning off push notifications that trigger impulsive trades and completely blocking all noise. Fourth, result, through this, along with the growth of our assets, we will reclaim the precious time of our lives, true freedom. Well, so far, we have built the great trilogy of investor behavioral psychology. In the first part, the psychology of money, we formed our fundamental attitude toward wealth and learned to wait for compounding. In the second part, nudge, we designed automated investment piping so money rolls on its own instead of relying on our willpower. And through the final third part, thinking, fast and slow, we established a metacognitive defense shield to monitor the broken cognitive distortions of our brains in real time. When this trilogy matrix works in perfect fusion, we will finally become the ultimate choice architects who win without shaking in the wild market dominated by greed and fear. Thank you.